Good morning, everybody. Welcome to the Reserve Bank and to our June monetary policy statements. I'm Alan Bollard. The Reserve Bank this morning is increasing the official cash rate. We're increasing it by 25 basis points to 2.75%. And that's marked by the fact that this economy has now entered the second year of its recovery, and we note that growth is becoming more broad-based. Looking internationally, we've seen a recovery in our trading partner economies continuing. We're noting that growth in Asia has been particularly strong, and that with ongoing growth in Australia and more recovery in the United States, this is offsetting the weaker growth that we've been seeing in some other markets. Overall, this has been contributing to the fact that our export commodity prices have been increasing sharply in recent months, and that means that export incomes have been going up as well. And in contrast to the stronger economic story, we do note, of course, the renewed turmoil in some financial markets. The main pressure that this is exerting on New Zealand is via continuing pressure on the cost of funds to the banking system. For the New Zealand economy, we forecast something around 3.5% growth this year and next year. The main drivers, they're export prices and export volumes, strong, an improving story in the labour market, and a pickup in residential and business investment. But despite that, we do expect to see households continuing to stay relatively cautious, with housing and credit quite subdued. This moderate housing spending, of course, has its other side, because it does imply that there is some rebalancing going on in the economy. The underlying CPI inflation is expected to track within the target range over the period, even as the economy expands further. We do, however, note that headline CPI inflation will be boosted temporarily by the increase in GST and by some of the other increases in government charges that have been announced. Provided that households and businesses don't reflect this inflationary spike into their own wage and price setting behaviours, then we do not expect to see lasting impacts on inflation in New Zealand. And as an outcome of this, and indeed as we've been signalling now for some time, we've decided to begin to remove some of the monetary policy stimulus that is currently in place. Further removal of stimulus will be constantly reviewed in light of ongoing economic and financial developments. We note a number of things about the forward track in interest rates. Bank funding costs are higher. Long-term interest rates look higher than short-term rates. And we've got a greater proportion of New Zealand borrowers using floating rate mortgages than in the past. And for these reasons, this should limit the extent to which the OCR needs to increase in this cycle compared to previous cycles. Ladies and gentlemen, thank you. We're open for questions, and to assist, John McDermott, Chief Economist, Assistant Governor, and Dean Ford, Head of Forecasting. Thank you. Any questions?
Dr. Bollard, how worried are you about inflation expectations, given what inflation has done over the last 5 years and the fact that you're looking at a spike to something north of 5% in the year ahead?
Well, I guess we'd make a distinction between underlying inflation, and the story there, of course, has been the global crisis and contraction around the world, and in New Zealand has meant that that has reduced pressures there, but we do note that in a number of countries that underlying inflation pressure has come off a bit, but not hugely. So some of that's still there. Secondly, Of course, then you've got the GST and other price charge effects, which are a hike on top of that. We do take a fairly benign view of this at this stage, which is that people will look through those effects. They'll see them for what they are. They're one-off, and we don't expect them to have a lasting impact through onto changes in behaviour. If we saw that happening, then our monetary policy response would have to be harsher than the one that's here in this statement.
Dr. Bollard, you say that interest rates may not need to go up as much as in the past. Can you give an indication of how far you think neutral is? How much is the rise likely to be compared with previous cycles?
Well, currently we see ourselves as easing our collective foot off the accelerator, but for the next little while we'll still be in very stimulatory monetary conditions, and that's going to be the main feature of monetary policy for some time, the rate at which we remove stimulus from the economy. We haven't planned out particular levels. We don't have a specific view about what the new neutral rate might be. That's ultimately going to depend on people's behaviour, on households' behaviour and on businesses' behaviour. We're going to be observing that incrementally. We're hopeful that we won't have to go into heavy foot on the brake. That's still some way off, and we've got a lot of time to judge that. But we have to say that people have changed behaviours after they've gone through the crisis. We'll be watching how much that's an enduring change or how much it's a transitional change, and that would impact where ultimately those neutral rates would be.
Can you tell me, please, how the Reserve Bank feels the economic problems in Europe? I mean, how much they contributed to this decision today?
Well, we've obviously been watching quite closely what's been happening in the financial markets in Europe. I mean, currently it's more a financial story than an economic story. It's been a very difficult financial story for Europe. We're obviously watching how much that spreads, what sort of impact it could have here. So far our view is that it contributes to the general volatility in financial markets, and that contributes to the continued strong the high cost for funds broadly, but it's not having a worse impact than that at the moment. However, these things can change and we'll stay alert to them. Would it have much impact on New Zealand trade? Well, currently we don't think so. New Zealand trade exposure into Europe is quite limited. It's less than 10% of our exports. Most of that goes to Northern Europe, which is actually in good shape, as opposed to Southern Europe, which is in poorer shape. We're not hearing of problems on those stories yet. Some of those Southern European economies are going to have a very difficult time adjusting and pulling back government spending. That won't apply right across the board in Europe. Some countries in Europe will be able to enjoy more competitive exporting conditions. So there's a lot of pluses and minuses in all of that. But above all, we have to keep watching the volatility. We will keep doing that. It's the sort of thing we will look at as we go forward on this monetary policy track.
Dr. Bollard, just to follow up, the 90-day interest rate track suggests about 300 basis points of rise over the next couple of years. What sort of impact do you expect that to have on household incomes and I guess the housing market as well?
Well, the housing market is, of course, something we'll be looking at pretty closely, because so far we've seen a very cautious response by householders back into the housing market. We expect that to gather a bit of pace, but still to remain quite cautious. Complicating behaviours in that has been the tax changes in the budget. Some people were expecting that to happen and may have already built that into their behaviours. On the other hand, we've yet to see exactly what that does around rental housing, owner-occupied housing investment, house prices, and property investment generally. So we'll be judging that as we go. We do see householders saying they want less debt on their balance sheets. we're going to be watching that one pretty carefully as well. Now, pushing up interest rates starts to make it more attractive to save in relative terms, less attractive to borrow, but at very, very low rates still. So overall, over this next year, we will continue to have very stimulatory conditions.
Do you have a specific forecast on house prices?
Yes.
So, thinking over the decline in house prices we saw, we lost about 10% on house prices. You'd expect that that 2007 peak would be recovered sometime early next year. In real terms, prices declined by about 15%, and we wouldn't expect that to be recovered over the projection.
Now, house prices have been a very dominant feature, driving a lot of behaviours in the New Zealand economy up into the crisis. We don't necessarily expect that to be such a big driver as we go through recovery. It's more a rebalancing story.
And just to clarify, in nominal terms, house prices, what sort of picture going forward then?
So we've got modest increases, so nothing more than 1 or 2% annual increases, so quite modest.
Do you see any signs of banks' access to credit on offshore markets easing just even in the last week or two?
Well, over the last couple of months, as the Greece debt crisis has rippled around world markets, access to term funding for banks internationally has got very difficult again. Now, this is something which opens up and closes up from time to time. And it has changed depending on the news at the time. So, over the last couple of months there's been times when banks have reported back that access to term funding has closed down again and then opened up and closed down again and so on. We're not particularly concerned about it at the moment in the Australasian system because the Australasian banks are well funded, and that's partly a result of the quick actions that we took during the crisis to push up liquidity requirements. We can already see that on bank balance sheets. They're in a more comfortable position in New Zealand and in Australia. So we don't have any particular concerns at the moment. But we are pulling out of a very nasty global financial shock, and there has been bad news in the recovery, and there'll continue to be volatile news in the recovery, so we'll keep watching that.
Given the pressure that those sorts of problems might be putting on banks' funding costs, did you give any consideration to perhaps keeping the rate on hold today and perhaps delivering a 50-point increase at the next review or the review after that if the storm started to look like they'd passed and inflation was becoming more of a problem?
We watched the financial story pretty closely, but in answer to your question, no, not specifically. We have a situation in New Zealand where we have an extraordinary amount of monetary stimulus. We're looking medium term. We're looking to make sure we're back on track so that by the time you start seeing a couple of years of recovery under our belt, we are in a position where we don't have inflation beyond the target range. So it's been very much a medium-term story. Now, if short-term financial events really bubbled away such that they impacted the medium term, then we'd take that into account.
You seem to have a fairly gentle tightening track going out. Would that be correct? I mean, is it possible you might hold off a rate rise next time and have more gentle increases?
Well, we've got this track which is removing stimulus, and as I said, that's the main story that we're looking at the moment. We'll keep reviewing it. So if we were to see financial market impacts having a real effect there, we'd take that into account. I mean, it's an incremental story. Each time we'll look at the decisions on their merits. There's no guarantee that it increases at 25 basis points over the next year. We'll keep looking at that. We're in quite a good position from that point of view. We've got a lot of stimulus out there. We will for quite a little while. We can, however, we think by moving now, have the luxury of taking our time to make a judgment each time on its merits.
Does the exchange rate, in terms of effect on stimulatory or non-stimulatory conditions, what impact's that been having?
Oh, well, as usual, the exchange rate's very important for our forecasts and for New Zealand economic futures. Of course, we haven't moved around that much over the last little while. The story this time has been very weak euro and corresponding bit more US strength. Actually, the Australian dollar has been a lot more volatile than the Kiwi dollar over the last little while. You'll see our projection is for gradually softening New Zealand dollar. That depends on a number of things. Yes, that can make a difference.
You've mentioned that bank funding costs have increased. Could you have allowed those increase in bank funding costs to do your work for you and not have to have increased the official cash rate?
Yeah, we already actually have had those bank funding costs do some of the monetary policy work for us over the last year. Actually, of course, we've been growing for a year. We've had reasonable growth for a couple of quarters. And over that time, there has effectively been a bit of a tightening put in place by those bank funding costs. So we've certainly taken that into account.
Tax changes in the budget in the end were easier on residential landlords than they might have been, and rather harder on the business sector than many expected. Is that a helpful or unhelpful mix from your point of view?
Well, I'm not sure there were really net surprises from the budget tax changes. I mean, the important things out of that for us were, first of all, a tightly controlled and transparent fiscal track. That was really important, given where the markets are on sovereign risk. Secondly, a story about net fiscal stimulus, which says, well, there still is some stimulus through this year, and then it tightens away, and that broadly looks like it's useful and fits in with monetary policy as well. And then thirdly, these particular tax changes that have changed the relativities of incentive for investment in property, in residential property, and in owner-occupied. And I think people had broadly forecast what was happening, so we haven't felt there's been a lot of surprises in that, but we've yet to see just what impact that has. And you can see our view on that. It's in our forecast. It says gradual recovery in both business investment and the housing market. We also note, of course, that the income tax reductions do compensate for effectively for price effects through GST, so we wouldn't expect though the GST increases to lead to wage demands off the back of them alone.
But it's not just the GST increase alone. There's all the other government charges that you point to, and an underlying inflation rate that the bank has said has been contained but not crushed by the recession and so on. Isn't there a risk, of a faster wage growth than you're assuming here, given that the experience of inflation over the last 5 years has been close to 3%, and people are now looking at somewhere between 5 and 6% over the year ahead?
Well, we've done a lot of talking around businesses and around unions, and the picture we're getting is of recovery in the labour market, but from a very low base and quite realistic expectations. So while we'll absolutely watch that carefully, we're not expecting wage demands to jump away as a result of that GST story, no.
Are you still expecting to increase the core funding ratio to 75% over the next couple of years?
Yeah, well, Bernard, I don't want to go into that in detail because this is about monetary policy, but broadly, yes, but continuing to watch the impact on liquidity and on bank balance sheets.
And what sort of financial crisis or meltdown would you need to halt your current track of increasing of the official cash rate? How serious would it need to be? What signs should we look for?
Well, we're not looking for any of this. We're expecting, in a reasonably confident way, to see the world economy to continue to grow. But, of course, we will be watching European financial markets, and the sort of things that we would look for would be any impact that either increases funds in term markets or freezes up term markets in any significant ongoing way. Any loss of confidence more generally around the place, any concerns into financial markets that made them look more closely not just at sovereign risk but external vulnerabilities, and anything that impacted through on the trade channels, so reduced New Zealand's exports. That's a long list, but we don't actually think those things are going to happen.
Just outlining the main indicators that show that we are in a positive economic growth for me?
Yeah, GDP. It's been growing for the last year. We haven't, of course, had the last quarter's figures, but we've got components of those, and those continue to look like they're going to contribute to significant GDP growth this quarter. If you then go through, you'll see a more patchy recovery underneath that. So there's some recovery in the housing market, but it's cautious. Business investment only cautious. However, export receipts very strong. As I said, some remaining government expenditure stimulus, but that's gradually coming off. But we now think that that recovery is broad-based enough to be reasonably confident about it. We don't see it as the fragile first steps out of recession. However, having said that, it's only later this year that we get back to a GDP position that we were in before the crisis, so recover that lost income.
You seem to be putting a lot of store in export receipts. Are there any question marks about how much of a boost that will deliver to the economy, given the very high levels of debt that the farming sector is carrying and pressure from banks to pay that back?
Yeah, I mean, we are putting a lot of store in it, and of course, because we're getting record export prices, record terms of trade, that's very good news that shouldn't get lost in the general concerns around things like European financial markets. That's flowing straight into New Zealand, muffled only by the exchange rate, and into farmers' pockets. Farmers generally are deciding to reduce debt. We think that's broadly sensible. It does reflect the fact that particularly in the dairy sector there was a lot of debt taken on in that first peak of dairy prices around 2007. So I think that leaves them in a pretty solid position. So we're not seeing it all going straight into consumption, which would have led to a faster pickup, but we are seeing it going into a more balanced situation where debt is reduced, not just by farmers, but by households and businesses as well.
Do you see any concerns around just a general lack of business investment? I know you expect it to pick up, but that might flow through to a more rapid improvement in the jobs market. That might put more pressure on inflation.
Well, I mean, we do expect to see business investment pick up, and New Zealand needs it to pick up. And a very important indicator there will be what happens to business credit growth, which has been declining. And we do need to see businesses borrowing and banks lending for sensible stuff. We expect that to happen, but we'll certainly be watching that, and banks of course have got a role to play in all of this, bearing in mind that many of their customers are very cautious after what they've been through now.
You've said that you expect recent tightening in lending standards to ease over the projected period. What makes you think the banks would do that when they've got their core funding ratio rising to 75% and the prospect of increased capital controls internationally?
Well, banks want to make money, and the way they do that is by lending to customers, and they can't afford to be in a situation where their balance sheets reduce and they're not actually actively out there in the marketplace, and we're hearing that from banks as well. It's in their interest to do that. In terms of, we've talked about core funding ratios, we actually don't think that that's a big impost on them. And in terms of prospect of tighter capital requirements, well, Basel, what's loosely called Basel III internationally, there's a lot of work going on, and they are likely to reach some conclusion about quality of capital worldwide. We don't expect that to have a very big effect through on the New Zealand market, and it certainly doesn't hurt the competitive positions of Australasian banks vis-à-vis their Northern Hemisphere competitors.
You said that in this tightening cycle, the extent of the increase in the OCR is going to be less because of floating mortgage rates and higher bank funding costs. Can you give us an idea of how big that extent of the reduction in the increase is?
Oh, good heavens. The extent, how big the extent of the increase in the reduction? That's third derivative, Bernard. Do you really want that in a press conference?
So according to your 90-day bank bill track, you're going from 2.5% to around 5.5%, 6%. Last time you went from just on 5% to 8.25%. That's the 3% increase. It sounds like you're doing a similar sort of increase just from a lower base.
Well, I mean, as I've said, we are removing or decreasing, and if you want all the stuff like this, increasingly removing the stimulus that's in there through the official cash rate. That's our main focus at the minute. Yeah, we've got a 90-day track in the publication which heads up towards 6%. That you've got to remember that maybe an enduring wedge between the 90-day track and the OCR track. It doesn't do that for a little while, and there's of course some uncertainty around those out years. At the minute we are looking at a picture of gradually removing stimulus.
There are some warnings that the rate rise is too early and business recovery is perhaps far more fragile than it appears. What's your response to that?
Yeah, I mean, we've noted a number of groups and lobby groups suggesting we should hold off for a while. That might be in their interest in the short term. I don't think it's in their interest in the medium term. We don't expect to get a lot of applause for starting to tighten now, but on the other hand, I think New Zealanders would be pretty disappointed if a year out we suddenly had to really start pushing up rates because we were behind the inflation story and they were starting to see savings inflated away. So we're taking a medium-term view on this, and that's what we're required to do in the Policy Targets Agreement, and that's why we're here. So I don't expect everyone to agree with this. It's been very well signalled. Actually, we've said we're going to do this about now for the last year, so no one should be surprised in it at all. Thank you. Any more questions? Well, thank you very much, ladies and gentlemen. We'll see you in a quarter.